Betting markets are starting to tip Donald Trump as the favourite to win the US presidential election because they see the former president as the likely winner of the battleground states, like Pennsylvania. This year, US small cap companies have jumped significantly in value. I caught up with Steve Johnson from Forager Funds Management a little earlier.
It's been a really good start to this financial year, particularly in July, but now again in October as well, where the Russell 2000 index has fairly significantly outperformed the larger cap index over there. That's been going the other way for 5 years. So for us that invest at that smaller end of the market, it's a welcome turn. And we've been waiting for it for a long time, but it feels like this could actually be the time where there's a changing of the guard and small caps have their time in the sun.
What's been driving the recovery?
Yeah, I think the prospects of lower interest rates are a big tailwind for small cap stocks. They tend to be more economically sensitive businesses. People have been really worried about recession and high rates for some time. So historical evidence has suggested that as soon as the economic slowdown starts and the rate cuts start coming, these small cap stocks actually start working. And that's what we've seen so far this financial year as well. So highly sensitive to rate cuts, and if it keeps happening, I think that will be a continued impetus for them to perform well.
Yeah, obviously a few cuts now from the Fed, could be one coming again in November. But in Australia, rates look like they're going to be on hold for a while. What does that say about small cap companies here? Yeah,
I'm actually a bit on the fence even in the US. I think we're going to get a few rate cuts there. They've been very clear about that. Inflation is back to less than 3%. You know, the interest rates are more than 5%, so that gap between rates and inflation is quite high, and they want to get it down to something sensible. But there's also pretty strong labour market, pretty strong economy. I don't know that inflation's going to keep falling from here. So it might be a percent and a half of rate cuts over there in the US, and then we have more normal sort of 4.5% rates for the foreseeable future. I'd really welcome that. I think back towards zero causes lots of distortions in the real economy and in markets as well. So hopefully we stay with something here that's sensible. Look, Australia never went as far, and there's a lot of debate about it, but we are still today lower interest rates than what they have in the US. Inflation is still higher here than what it is in the US. So I think the RBA is right to say not yet. But I think the evidence is building that we will see rate cuts here. If not late this year, then certainly the first half of 2025.
The other big thing in the States is obviously the US presidential election. Looks like, according to the bookies, Donald Trump is firming up as the favourite. If he does win, what would that potentially mean for markets and some of the sectors across the market?
Yeah, it's been a pretty significant shift over the past couple of weeks. Both polling and the odds that the bookies are applying, and I'd say the odds are probably more reliable, more real time than the polling. Trump has been gaining a lot of ground in important swing states, not so much overall, but in important swing states. So markets are certainly starting to price in a Trump win, and I'd say, if anything, you can expect that to be a bit of a non-event for markets if it happens, because it is expected. If it's the other way and Harris wins, that might be more of an upset for markets. And I think things have run hard, assuming they're going to get some favourable domestic policy for US businesses. So all of the onshoring trends, chip manufacturers, there's a lot of policy that's dependent on Trump getting in. So I think it's more likely to be a negative event if it's the other way, and a bit of a non-event if it is, as the bookies are predicting, a Trump presidency. I think sector by sector it's going to be quite different, though. We own a solar tracking company that's listed in the US. Its share price has halved over the past 6 months because people are worried about the incentives that have been behind that sector going away under a Trump government. So there are some sectors that will suffer specifically and some that will benefit. But I think in terms of the overall market, it's pretty well priced in now.
Yeah, well, it's also the earnings season right now in the States, and we've got the big tech company NVIDIA the next couple of days. They could be a beneficiary as well, and if Trump wins.
Look, I think they're a beneficiary of the way the world's going.
Had a red hot year, haven't they?
Yeah, and it's largely in the price. We saw ASML out this week mistakenly releasing their earnings early, and it was a bit of a shocker in terms of demand in that semiconductor space. So I don't think there's any doubt that the NVIDIA result is going to be very good. I feel like there's a bit of heat coming out of it, though. There are people starting to ask questions about whether this enormous hundreds of billions of dollars of investment that's going into the space is ever going to generate a return. I think there are more companies going, we actually need to think about that equation. It's not just spend the money, it's what are we going to get out. So I think over the next 6 months, it's not going to be this result, but I think over the next 6 months, you might see some of the heat start to come out of that space, and that will have a direct implication for NVIDIA. It is one of the world's great businesses, though, and that shouldn't be forgotten.
All right, looking at Australia, our market this week has been at all-time record highs. We've seen some record share prices for some of the bank. I know CBA shares have been really strong over the past few months. Like, what's been driving the bank rally here?
Well, that is a question I don't have the answer to, other than a lot of passive money. CBA is...
People are saying they're overvalued, but people keep buying into the shares and it keeps going up.
CBA is the biggest stock in the index, and the passive money, so index funds, are now almost half of the Aussie market, and there's a lot of money coming into it. So the money goes into the index fund goes and buys CBA shares. They're not sitting there thinking whether that's a good investment or a bad investment. So I think there's a lot of that going on. Other than that, I can't explain it. We own Lloyds in our international fund. That's a UK bank. I think it is as good as CBA. It's actually post-crisis. They've had their problems over there. They're holding a lot more capital. They're very, very tightly and heavily regulated. It trades at 1/3 of the multiple that CBA trades at, and the stock's actually done okay over the past 6 months, but the gap between it and CBA is just crazy. So I don't really understand our domestic bank valuations at the moment. I think people are taking on more risk there than they should be. Look, I'd say in terms of the overall market, I started my business 15 years ago. The ASX has delivered 8% per annum over the past 15 years, including 4% per annum of dividends. So you've had capital gains of 4% per annum. It's not crazily high. In fact, that's bang in line with what it's done over the past 100 years. And I don't feel like it's stupid. It's not super cheap and everyone should be backing up the truck, but you should expect the market to go up over time. And the fact that it's at highs, I don't think suggests that it's stupidly overpriced. And I actually think there's lots of pockets out there to be doing interesting, sensible, long-term investing at the moment.
And the China stimulus, just quickly, has that done much to markets here in Australia?
Well, it was a short-term kick for sure for the commodity sector. I am very, very worried about that Chinese economy medium to long term. I think it's been clear for some time that it is at risk of going down the same path that Japan went down. They're going to have a shrinking population very soon. They have an economy that is far too heavily dependent on investment and not enough on consumption. And these policy responses are, let's borrow more and do more investment rather than trying to make the painful but necessary adjustments to their economy. So, look, I'm nervous about especially iron ore medium term, simply because that Chinese demand, it has to change. Otherwise, they're only stocking up bigger and bigger problems.
Steve Johnson, Chief Investment Officer at Forager Funds Management. Thanks for coming on the show.
Thanks for having me.